Welcome to the Professional Edge. My name is Todd, tax attorney, CPA, and certified financial planner. And this week we're talking about investing, what you might need to know. And if you follow the headlines this week, it's been pretty exciting. We had the GameStop, which has been touted on the Reddit stream, and we have seen a lot of these hedge funds get caught in their short positions. And basically a short position is they are betting that the stock will fall in value, and therefore they can replace those shares on a cheaper amount. And the amount of leverage that these hedge funds have had is 130% of the outstanding stock. So they basically have oversold the stock. So when this group now touts this and says that we need to push the value of GameStop up, it hit $435 per share, then these hedge funds have to actually close out their contracts and buy these shares for $435 a piece, and they were expecting to pay $10 a share. So it puts the quote squeeze. So that's one thing you need to know about investing, and that is there is substantial risk. There's no guarantee on this. And, you know, a lot of these hedge funds are now crying foul. The Attorney General of New York is getting involved. The White House now, there's supposedly congressional hearings going to be touted on this. And we are going to see how this plays out and whether there is a free market economy. But we all have to remember that we can't tout things that are not true. So if we have a group of friends and we say, hey, let's all buy GameStop, we can do so. But we can't go out and try and say, oh, you know, we are going to make GameStop profitable and basically give misinformation. So again, you know, investing, what you might need to know is with this trade on GameStop, it defies fundamentals. GameStop has roughly 5,000 retail units. They do basically use game sales, some console sales, but the method of delivery is now via the internet, and therefore it's not the CD-ROMs that you take and trade in anymore. So, you know, the idea was GameStop's going to go the way of Blockbuster. So that's why all these hedge funds were shorting the stock, thinking it's going to fall, and they were going to make money on the fall. But then, you know, with this large momentum, the price was bid up. So we're going to see how this all plays out. But you as a listener here on the Professional Edge, hopefully you don't get into this, quote, gambling frenzy that's going on. Because when this stops, then the people that bought in at, let's say, $375 a share, and it crashes back down to reality at $20 a share, well, they're going to lose $350 a share. And unfortunately, the unsophisticated investor is going to get crushed. So again, if this is your speculation, that's not investing. That is basically gambling. So that's not going to get you to that safe and secure retirement. So what do you need to know about investing? Number one, it depends on your time frame that you outline for yourself. If you're trying to save money for a house, for a down payment, or a car, then that's not going to be where you use your investment dollars. Investment is for a longer term strategy. So if you're saving for that house or saving for the car, just put the money in a money market account. That way you can't risk your principal. You're not going to make much on that money. But that's okay. That's not your investment portfolio. That is your savings account, which is okay. Now, we all know savings accounts are paying less than 0.5% rate of return. But if you are an older listener here on the Professional Edge, then you may have ample cash, $200,000-300,000 in the bank. And that's earning, again, less than 0.5%. And it would be wise to reallocate part of that to invest that. And if we just move one click on the dial on the risk continuum, you may say, give me a short-term treasury note, and that might yield 1 to 3%. If we do 2 clicks on the dial, then we might do a AAA corporate bond. That would be anywhere from 4 to 5.5% rate of return. Now, again, as we click this dial, we click the risk, and again, the risk and reward is the higher the risk, the higher reward. So when we compare that with a high yield corporate bond, then that might be in the 6 to 8% yield. And again, you got to price these things out. So again, we had one client which wanted to develop a municipal bond portfolio because he wanted to receive tax-free income. Well, lo and behold, the individual, the coupon is $1,000, and the client was not that sophisticated in the financial arena, and somebody helped him out at one of these large brokerage firms. And when we got the trade confirmations that came in, basically the client had paid a premium to buy that bond that was yielding 4.5%. That's what it stated. And that's all the client really recognized was that 4.5% on the coupon. But when the client ended up paying a premium for that, and some was 1.12, that means the client paid a 12% premium. So for a $1,000 bond, the individual paid $1,120. Well, when you do the math on that, and this is something, what you might need to know before you do this and do municipal bonds, is that premium then actually gets factored into your rate of return on that bond for what is called yield to maturity, YTM. So the yield to maturity, when you factor in that premium that the client paid, was nowhere near that 4.5% coupon. Now, if he's the owner of that bond from that point forward, he is going to receive that 4.5%, which is the coupon rate. But you got to factor in the premium that he paid for that. And remember, the premium was 12%, so he paid $1,120 for a $1,000 bond. You say, wow, why would he do that? Well, because in the market, we're getting less than 0.5%. So again, the pricing of that bond has to go up to equal the market rate of return. So the client never really realized, nor was it disclosed to them, that he was paying a 12% premium to receive this 4.5% coupon. When I went through this, and it took a better part of 2 hours to explain this on how this actually works, and the client couldn't understand. He's like, well, I'm getting 4.5%. I'm like, you're exactly correct. You are getting a coupon of 4.5%. But you have to take into account that you paid more for that bond than what it was actually going to mature for. So when you take that into account, what is your yield to maturity? So you, as an investor, what you might need to know, what is your yield to maturity on this bond that you're thinking of considering buying? So again, that's another thing that we help our clients with at Estate Management Counselors. These are simple things, but they make a huge difference. And for the client, unfortunately, his yield to maturity was 1%. So he's invested millions of dollars. He's yielding 1%. That's the real yield. And at that point in time, when the client invested these millions of dollars in municipal bonds, he could have went to the bank and got a CD that was actually paying 1.2% with no risk. So, and there was 100% liquidity, because the other thing which happened, the interest rates adjusted, and therefore the value of that bond portfolio fell. Again, listening here on the Professional Edge, we all understand the inverse relationship between interest and pricing. So if interest rates rise, bond values fall. So unfortunately, this client also had a double whammy, because the interest rates adjusted and the value of his bond portfolio fell. So now we have a double-edged sword. He can't get out, and he's only yielding less than 1%. So that's an unfortunate thing for this client. And that's, again, working with a registered investment advisor. I have a fiduciary duty to act in the client's best interest, and stockbrokers only have to provide suitable recommendations. So again, that's a wake-up call. If you're working with a 1-800 number or a stockbroker, just realize that they are not a registered investment advisor, and therefore they only have to provide suitable recommendations, not in the client's best interest. So in order to sit down and have a conversation, give our office a call at 877-654-9798. That number again, 877-654-9798. So when we're thinking about what else you need to know about investing, and there's different vehicles that we can invest in, and that would be, for example, a regular brokerage account. These are after-tax dollars that you get from your paycheck. Instead of putting that in your bank, you open up an investment account and then put some dollars in there. Let's say you put $1,000 in. Well, you can buy stocks, bonds, and mutual funds within that account. Now, at the end of the year, we know it's all tax season, and we're getting these 1099s. And if you buy one mutual fund and you don't sell that mutual fund, you could have a taxable event, because inside that mutual fund, that active manager buys and sells stocks within that mutual fund. And those are actually tax attributes which come down to the client on the 1099. So even though you never sold anything within that client portfolio, that brokerage account, you could actually have a taxable event, because inside the mutual fund, it's called turnover, because they buy IBM, buy Home Depot, sell IBM, buy Lowe's. They just move the portfolio around. So depending on the turnover ratio within that mutual fund, then you, as the holder of that mutual fund, would have a taxable event, because those tax attributes come out to you, the investor, on your 1099. You'll see that coming up tax season. And therefore, you're going to have to report these short-term capital gains, long-term capital gains, some dividends, maybe some interest, depending on the fund in which you're investing. So even though no sale or disposition, you have a taxable event. So what you might want to know is, what is the proper allocation within an after-tax account that would reduce your taxes? And that's what we help individuals with at Estate Management Counselors. Being a tax attorney and a CPA, we're licensed to give tax advice to our investment advisory clients, and that's what we do. And if you're not getting that tax advice, then you're actually not getting the full rate of return, because if you take into account the taxes that you pay, then that actually reduces down your overall rate of return. So if you're not getting that level of service, and again, a 1-800 firm is not licensed to give tax advice. Stockbrokers aren't licensed to give tax advice, but we are. So to start that conversation, give our office a call at 877-654-9798. That number again, 877-654-9798. On the next session, we're going to talk about more things you might need to know as an investor. My name's Todd, tax attorney, CPA, certified financial planner, host here on The Professional Edge. We have more coming up.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with call his office at 877-654-9798. That's 877-654-9798. Do you want to feel more confident about making the right investment, tax, and estate planning decisions? Today, these decisions are more complex than ever. Have you thought about working with a professional advisor and not sure who to turn to? Not sure what qualifies one to be an advisor? Todd is more than qualified as a tax attorney, CPA, and certified financial planner. is with Estate Management Counselors. Estate Management Counselors operates as an independent fee-only investment advisory firm. They're dedicated to gaining a personal understanding of their clients' objectives and implementing professional counsel and advice to achieve those objectives. So take a second to talk with Todd to learn how you can benefit from their multidisciplinary practice, where they coordinate their clients' legal, tax, and investment strategies into one comprehensive and integrated plan to enhance and protect their clients' financial security. You can reach Estate Management Counselors and speak with Todd by calling 1-877-654-9798. That's 1-877-654-9798.